the correlation between those tectonic plates, stock market movement, bond market movement, is greater than it's probably ever been. So if you're looking at one market, let's say you're a gold bug, don't just look at gold. Watch the stock market, watch the bond market. To some extent, watch the dollar index. Correlation there is not that great, by the way, between gold and the dollar index. But as those markets move, it's going to impact gold even more. But gold doesn't always wait for events to happen or a headline report to come out, a CPI or PPI to say, oh, now I can move. No, gold's been around longer than any of these markets. It's smart. It anticipates.
Market analyst Michael Oliver emphasizes the role of unexpected factors in driving significant market changes. In this context, gold has emerged as a standout performer, signaling a broader trend in the precious metals sector. Despite gold's record highs, Oliver's momentum analysis suggests silver and mining stocks are on the brink of a rally, aiming to narrow their performance gap with gold. Oliver links gold's ascent to vulnerabilities exposed by previous Federal Reserve policies, which inflated asset values to risky levels. He anticipates a correction in overvalued sectors like real estate and stocks, potentially triggering a shift back to inflationary policies by central banks. Such a pivot would likely benefit gold, reinforcing its status as a safe haven amid economic uncertainties. As investors navigate these turbulent waters, gold's leadership in the precious metals market stands as a critical indicator of broader economic trends. The anticipated rally in silver and mining stocks further underscores the dynamic interplay between market sentiment and economic policies. Oliver's insights provide a valuable perspective for those looking to understand the forces shaping today's financial landscape. Now we'll show you the best clips of the latest interview, but first, subscribe, and check our pinned comment for some massive sign-up bonuses. Enjoy the video.
How much above or below on an oscillator to the 3/4 moving average. It's sort of fairly long-term yardstick. And what I saw was not what you saw on the price chart. Price chart was this upward arcing action. You could hardly draw a trend line because it steepened. But on momentum, it was a floor. Bang, 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 hitting the same level each time. Over a span of a year and a half or so, the same oscillator levels would occur. As soon as we changed quarters and got into October, November, December of 87, the new quarter, the 3/4 average had moved up. Boom, we blew out the structure on momentum in the second week of October, and we crashed right away. Literally it was a 35% drop, which is the normal definition of a crash, in a matter of a week and a half. I was a bit stunned, but not totally shocked because I got short. I bought puts. Now, once I learned that, I spent the next 5 years, still as a broker, futures broker, developing the methodology, applying it on different time scales in different markets. So I didn't just look at long term, but I'd look at intermediate term, short term, and all that. And those can sometimes be different. You can have a market that's in an intermediate upside, but it's in a long-term downtrend, if you get what I mean. Anyway, in 1992, we started MSA. Our primary customers were major institutions, banks, a large fund, a huge billion-dollar fund for timing research to them. And then in 2015, we opened up to retail subscribers. We analyze all 4 major asset categories. That would be the stock markets, bond markets, commodities, emphasis on gold and silver, and foreign exchange. And I say right now, especially in all the years I've been looking at things, the correlation between those tectonic plates, stock market movement, bond market movement, is greater than it's probably ever been. So if you're looking at one market, let's say you're a gold bug, don't just look at gold. Watch the stock market, watch the bond market. To some extent, watch the dollar index. Correlation there is not that great, by the way, between gold and the dollar index. But as those markets move, it's going to impact gold even more. But gold doesn't always wait for events to happen or a headline report to come out, a CPI or PPI to say, oh, now I can move. No, gold's been around longer than any of these markets. It's smart. It anticipates years where gold's held relatively sideways, and now of course upside. They've drifted down. So it's like they don't correlate to gold. Well, they do. But over history, silver and the gold and silver miners will tend to either outperform gold vastly sometimes or underperform it. Well, they've underperformed since mid 2020. They've been going down relative to gold.
Okay.
I think that's going to change. Another thing to watch very carefully right now is like you mentioned, the stock market. The stock market, we turned negative on in terms of investment grade decision about being long or not being long in January of 2022. Now, since that time, the markets, S&P, NASDAQ, et cetera, all dropped fairly seriously into 2022 later in the year. And then they based and turned back up. And now very narrow measures of the market. S&P 500 because of certain front-end loaded symbols. NASDAQ 100 even more so front-end heavily weighted symbols. Literally a handful of symbols have caused those two indices to exceed their 2022 highs. In the case of NASDAQ, its high was actually in late 2021 by about 5 or 6%. Most metrics of the stock market have not gotten back to the 2022 highs. Okay, forget that for the moment. The issue is, when will the stock market turn down? Because I argue, MSA argues, that when it turns down, all these data points that everybody's looking for to soften, to cause the Fed to soften, will follow the stock market, not leave the stock market. That's usually the case. You go back and look at the top in 2000, look at the top in 2007. It was after those tops in the stock market that you suddenly got bad numbers. It said, oh, economy's weakening. Okay. And if you are counting on the Fed to soften, now they've already softened to the extent that they're not raising anymore. Okay, we know that. Okay, the only debatable issue, when are they going to cut? Okay, and Powell keeps going sort of back and forth on when he's going to do that. And, and now you get a number today that, well, they're not going to cut and all this stuff. When that stock market starts to weaken and you start getting those data points, the Fed will cut. They've already said they're ready to cut whenever they see it justified. The problem is, if you go back and look at the 2000 top and the 2007 top, when the Fed started cutting, short the market. It's when they ended their rate rises and then started the cut that the market collapsed. So the assumption that if the Fed cuts, that's good for the market is not a valid historical assumption. It's totally wrong.
In a market environment characterized by volatility and uncertainty, Michael Oliver brings a keen focus to precious metals, advocating for their strategic role in investment portfolios. Highlighting the notable undervaluation of mining stocks relative to gold, Oliver sees potential for significant revaluation as market dynamics evolve. This anticipated shift is partly driven by a movement of investors from high-flying tech stocks to the more stable grounds of precious metals, suggesting a broader trend towards seeking safety amid market turbulence. Oliver's analysis doesn't stop at precious metals. He casts a wide net over the broader economic landscape. He emphasizes the importance of vigilance in monitoring key market indicators such as S&P 500 levels and T-bond movements. These indicators, he argues, are bellwethers for potential market adjustments, urging investors to adopt a cautious stance in the face of impending volatility. This strategic caution is rooted in an understanding of the interconnectedness of markets. Gold's role as a safe haven is more critical than ever, offering a bulwark against the unpredictability of global financial systems. Moreover, Oliver's reliance on momentum analysis serves as a reminder of the importance of looking beyond traditional metrics to anticipate market trends. As investors navigate the complexities of the current economic climate, Oliver's insights provide a compelling case for the inclusion of precious metals in diversified investment strategies. His call for caution, grounded in a thorough analysis of market indicators, offers a prudent path forward for those looking to mitigate risk while capitalizing on the opportunities that volatility inevitably brings. Now, we'll show you more clips, but first, subscribe and turn on notifications so you do not miss out on our daily videos. Let's get back into the episode.
If you have a stock or an index that keeps coming down to the same price and holding at a given level That's called a floor, right? Okay, and if you break it, therefore it's negative, okay? Or if maybe you have an uptrend on a price where it hits this trend line 2, 3, 4 times, and if you break it, therefore it's negative. Well, when we look at momentum, we see something different than when we look at price. Price has this upward action since October. This is October, November, December, January, February, March. Okay, now marginal new highs in March. So it's like 5, 6 months of rally. When you look at momentum of price, measuring, for example, the monthly price action of the S&P and its relationship to its 3-month moving average, okay, and you plot the oscillator, you don't see an uptrend, you see floor. December low, January low, February low, and now early March low, all at the same level on the momentum chart. So, if it were a price chart and you were looking at it, you'd say, oh my gosh, where do I break it? Well, I'll tell you where you break it. Around 50, we're 15, what would you say our price is now? 50?
51.48.
51.48, okay. About 1% to 2% under their S&P blows that floor. Now, when you look at a price chart, you say, well, gee, dropping back to 100 points under here or 75 under here, that doesn't break anything on price. But on momentum, it blows this massive floor. On the NASDAQ, it's right around or just below today's traded low. You better not close a day there. So in other words, if we see the S&P start to ooze on down later today and tomorrow, much below today's low, and NASDAQ do the same, NASDAQ 100, assume that the monthly momentum topping process, and it's a pretty good size metric. In other words, when it breaks, it tends to go in the new direction for a handful of months. You can't afford that because when I go to larger scale yardsticks of the momentum trend measure of the stock market, like quarterly momentum or annual momentum, you can't afford a 5 to 10% drop because you'll blow structures on those momentum charts, indicating we're fully resuming what started in early 2022. Also, if you go back and look at the 2000 top, MSA turned negative in January of 2000, and we cautioned, we said, but be careful, it could wander sideways for a while because we saw some reasons it might. And it even made a new high in August of 2000, above and beyond where we said sell it. And in 2007, we had predicted in 2006 the high would likely be between 1550 and 1600. Well, it took all during 2007, it sort of went sideways. And then finally, with the Fed rate cut, it popped up into that zone and broke out on a price chart. Momentum was laughing at it. No breakout on momentum. But price said, oh, look at me. As soon as you started the rollover and got into early 2008, you blew all these structures. And it didn't take much of a price drop to do it. What happened? A massive bear market. We have the same situation now, where you can't really afford to knock the little domino over because there's some bigger dominoes that'll topple and the thing will cascade. So I'd say right now, if you're long the stock market, you don't want it to drop 1% right now. Invariably, they're lagged to reality, their own reality. In other words, by the time they start cutting, the reality is already set to happen. And all of a sudden they have a bust and they have to panic and go the other way. I think also the Fed this time is, though they've not admitted it, take a look at a bond chart, T-bond futures, or TLT, the ETF of T-bond long-dated bonds. And look what happened last summer into October. Now, we predefined the event as a nuke event, meaning we thought the T-bonds were going to crash. And they did. Between August, September, and October of last year, they really went down precipitously, almost like some commodity market that was limit down type of thing. And they went down more so than other bond markets, including private credit markets. They declined too in price, up in yields, but the T-bonds were down worse. Now, the long end of the debt market is not the end of the market that the Fed has the best control over. And so when it got out of control last year, I think that put a spook up their backbone. I think it spooked them. And it demonstrated, one, they're not in control of that market, which they need to be. And two, it could get out of control in terms of its real world impact on the housing market, other markets, commercial real estate, and so forth. And there's all kinds of problems related to that the Fed knows about but can't talk about. Like CalPERS, for example, the retirement fund in California, they have, like, I understand, like a 17% exposure And I think it was even leveraged to some extent in commercial real estate. And so all of a sudden they're hurting like heck. Well, I mean, that's beyond government as such, but it's the kind of event that if you start getting those kind of headlines, not a bank related headline, but a retirement fund, what does that do to the general public? It creates panic. I mean, I'm not getting my normal increase in my pension fund payout because to keep up with inflation because they're hurting, and it's a nightmare for the Fed. They know it. They're aware of it. For the Fed cut rates for the first time in years in mid-September 2007. About 4 weeks later, the rally ended. That was the top. Fed cut rates for the next few years. Market collapsed. Okay, forgetting that. Back then, when the S&P rallied for that final high, if you looked at certain other markets, real estate related, financial related, they weren't making new highs. In fact, some of them were in a sharp down. So just like today, we have not residential real estate like back then, the mortgage market, but commercial real estate in an implosive situation, and yet the market's ignoring it. Well, it did the same thing back in 2007. And it finally snapped and paid its dues and caught up with the implosion that was going on in the real estate market. So that's a good comparison. Yes, markets can ignore stuff like that, but it doesn't mean those things aren't valid.
What do you think of Michael Oliver's take? Are silver coins the way to go in a doom and gloom scenario? Post in the comments section down below how you're preparing for this type of event. Share this video with a gold bug and check this video right here because it's a perfect fit for you. I see you on the other side.